This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Page 47, the objectives of an audit, primary objective of the statutory audit. I was once asked by a student, I was teaching, forgotten where it was, Eastern Europe somewhere, I think it was Latvia. I was asked by a student, who are these statutory auditors? You keep mentioning the statutory audits. Who are the statutory auditors? I know about the Big Four and about other firms of auditors, but who are the statutory auditors? So we then had to explain. I do remember him now. I remember where it was. It was in Latvia. When he had to do the last three papers, the core papers, which was paper 3.5, 3.6, 3.7, and you had to do them all at once, and you had to pass all three. This particular student got 50 in paper 3.5 and 50 in paper 3.6. But in paper 3.7, he scored 50. Now that's precision. That is precise shooting. No wasted effort in any one paper. 50, 50, 50. And he wasn't alone, not in the same sitting, but there was another guy from the same country, from Latvia, who also got 50, 50, 50. And I'm thinking that he is as well qualified as the senior partners in the Big Four audit firms. He's ACCA, the same as the world prize winners are ACCA. There's no difference. You don't have uppercase bold italics for the ones in the top bit and lowercase small font faded in yellow for the ones who only scraped through. We're all ACCAs. Worth thinking about. And no one's ever going to ask you, did you pass your exams first time? No one's ever going to say, I see you're ACCA, did you pass your exams first time? I was talking to two of the Big Four partners here about 6 months ago, and neither of them passed all their exams first time. I did. John did.
You said that you did not pass the CCA exam.
I did.
You did?
I passed my chartered accountant's exams. Yeah. Okay, page 47. The objective of the statutory audit, carried out by the statutory auditors, who are these people, is to give an opinion on the truth and fairness of the financial statements. During the audit, we're going to assess the risk attaching to the entity, together with an assessment of the internal controls. And these procedures will assist the management in reducing risk and improving performance. When we're assessing the internal controls, when we're assessing risk, we're going to write to management. We're going to write our weakness letter or letter of recommendation. It goes by a variety of names depending on the firm's own title for this letter. But recommendation letter, or letter of recommendation, weakness letter. Arthur Anderson's used to call them bluebacks. Used to call them a blueback because their letter would be bound in a blue folder. And so they call them bluebacks. But they go under a variety of names. But they all are letters recommending amendments, changes, improvements to the existing accounting and internal control systems, and also recommending that management should potentially take mitigation actions against risks which the auditor has discovered or the auditor has assessed. What are the limitations of the statutory audit? What are the limitations? Why is it that some people say, well, what value is this? What use is it? It's looking backwards, it's not looking forwards. All it is doing is reporting on historic events. There's no indication within the statutory audit what lies around the corner. There's not even an indication of what the financial situation was on the 1st of January. It's only the position on the 1st of December. There's not necessarily the limitations of the statutory audit. I was going to say so, I've changed my mind. It's not a limitation of the statutory audit. The audit report is full of jargon. The man in the street, the user of the financial statements, the man in the street, if you believe that, doesn't understand, surely. If I say an audit involves, and this is by way of explanation, this is educating the man in the street. An audit involves obtaining evidence about amounts and disclosures and sufficient to give reasonable assurance. What's reasonable assurance? That the financial statements are free from material misstatement. What's material misstatement? Whether caused by fraud or error. Consistently applied, adequately disclosed. The reasonableness of significant accounting estimates made by directors. And then in the audit report itself, the opinion itself, in our opinion, the financial statements give a true and fair view. What's true and fair? What does that mean exactly? Does it mean accurate and correct? No, it means true and fair. It means corresponds with reality and it's reasonably close to possibly what might be the real situation. So it's jargonized and it's become standard, and in that respect it loses its meaningfulness. If it's just a standard routine thing that auditors write and just change the name and the date, then it loses its relevance, meaningfulness. I don't know, what do you think? I can see you agree. Okay. What are the limitations? Other limitations. It's jargonized, it's become standard, it's only reporting on history and not reporting on the future. It's rounded, so the degree of accuracy is lost, but that's arguable because the accuracy is accurate to within material limits. So the currency identified in Deferred's accounts is to the nearest 1,000. What else can we say as a limitation of the statutory audit? It's expensive. PricewaterhouseCoopers in Deferred, PricewaterhouseCoopers got, I think it was 573,000 for the audit of the Deferred Group. Just over £500,000. Limitations of statutory audit. Yeah, okay. It's changed just recently because private companies now, no private company has to have an audit. They can elect to have one, but they don't have to have one. But until that recent change, even some private companies had to be audited. All public companies must be audited. Not public quoted, public companies. And in a public company, it's possible, I think I'm right in saying, I think the law's changed. I think it's possible now to have a public company with just one shareholder. And it has to be audited. For whose benefit? For the auditors. Yeah, the auditors are going to benefit. The shareholder. So you're going to report to Miss X, the shareholder, on the stewardship of X PLC's assets by the director, Miss X. What's the benefit of that? So it's expensive in terms of, particularly, it's expensive in terms of the benefit, because even the small private companies have to be audited, public companies have to be audited. And there are public companies with only minimum number of members, and therefore you're reporting to the members about their own stewardship. What's the value added? And you have to query it. So one of the limitations is it's a broad brush figure. It says all these companies, you're going to have an audit, like it or not. That's the price you pay for being a public company. The auditor will perform substantive tests on the transactions and balances appearing in the financial statements. In the earlier auditing paper, consideration was given to some of the easier audit areas. So here are some more exotic ones. The audit of inventory and construction contracts. I think I'm right in saying construction contracts. Oh no, it's P2. I was going to say construction contracts is out of the syllabus, but it's out of P2 syllabus. Inventory is normally a significant asset. It's normally, for a manufacturing company, it's typically a significant asset. Typically it's the biggest current asset. It has a direct impact on the profit for the period. It has a direct impact on the balance sheet. And the two balance. If you think about a balance sheet and you reduce the asset of inventory, then something on the other side must also decrease, or there has to be a corresponding increase on the asset. So as inventory value decreases, so also the retained earnings decrease. And as they increase, then so also, and inventory is its own double entry. If you increase inventory, the profit goes up. Decrease it, the profit goes down. So it's a figure which is capable of manipulation, and it is potentially the case that a company will determine in its own mind, let's take it one step extra, they will determine in their own mind how much tax they want to pay. So if you start at the bottom of the tax computation and work back up, you can find out what the profit before tax has to be. And if you establish what that figure is, then by the manipulation of the inventory figure, you can arrive at that profit before tax. It is a figure which is available to be heavily abused and used to determine what the profit shall be, rather than what the profit genuinely is. So it's of major importance in any set of financial statements, and therefore of major importance for auditors where inventory is a material figure. It's also, if there is to be misappropriation of assets, it's also the best asset to steal, which we covered yesterday. It's the sensible asset to steal. If a client's employee is looking to steal from his employer, then inventory is the thing that you should be advised not to do. Inventory should be valued at lower of cost and NRV. Many methods available for estimation of cost. FIFO, LIFO, AVCO. Standard cost. LIFO no longer acceptable. Base stock method no longer acceptable. There was a question, I don't know if it's still in the P7 revision kit, there was a question where one of the lines of stock was valued on a replacement cost basis, on a market value basis. Allowable or not? No. No, I said that as well until I read the answer. And apparently there is. There's a category of inventory which you can value on a market value basis. Things like gold bullion, bars of gold, and I presume therefore also gemstones. Marketable commodities like gold or diamonds or platinum or copper, aluminium. And I would imagine diamonds and sapphires and emeralds and things like that. But I can extend that as well. If it's a marketable commodity like that, then I would imagine that you could value, for instance, coffee or sugar on the same basis. That you buy it in bulk and you can sell it in bulk. And because it's a volatile market, then it can be valued at the year end as at market value. And it staggered me. I was really quite shaken when I read that as an auditing answer. There's one called the retail scheme, where you value inventory. A shopkeeper will value and work out what his overall retail value of his inventory is, how much you can sell it for, and then deduct an acceptable profit margin. His normal standard profit margin, just deduct it from the resale value. So that's the retail scheme for valuing inventory, and that's also an allowable method. Page 48, where standard costs are used, what factors would you consider before accepting them as an appropriate basis for the estimation of cost? Where standard costs are in use, standard costing system, what should you consider in your assessment of determining that standard cost values are appropriate? Well, shall I help you? Shall I help you here? How up to date are they? When was the last standard reviewed? When was the last time and motion study? When was the last occasion that management timed various operations in a manufacturing process and computed or multiplied that time standard by the current rate of pay? So there's probably been a pay increase since the last year, so we need to make sure that the hourly rate of pay is applied to the revised or renewed or reassessed time period to take to do the operation. How material is the inventory in the context of the financial statements? Do we really care that the standard costs are no longer applicable if inventory is immaterial? Has there been any change in the level of seniority of the people who are doing the operations? For instance, if a job used to take 3 skilled men and 2 semi-skilled men, has that shifted now to 2 skilled and 3 semi-skilled? Because that will be cheaper. So, again, how up to date are the figures which we're using within the standard costing system? How reliable are the extensions of the hours multiplied by the rate per hour? How accurate is the estimation of fixed overheads in order, when we're on an absorption cost system, how accurate has the company been historically in establishing or estimating their fixed overheads? Because that will then determine fixed overhead absorption. How close has management historically been in estimating production levels? Because that again determines fixed overhead absorption rate. So these are matters to consider, and that's going back to your F2 days, F2 and F5, absorption costing and marginal costing. And it's something I said yesterday, that even though you're doing P7 and you're rapidly soon going to be qualified, this is an accumulation of knowledge that you've never forgotten. So I should be able, and your examiner should be able to ask you any question at all which concerns law, and you should be able to bring that into your auditing answers. The same with P2. P2 examiner can ask any question which involves law and bring it into a P2 question. It's a cumulative thing. And once you're qualified, you have this store of knowledge. You don't empty it out. You keep it up and keep it topped up. Can you think of anything else that I may have missed from example 2, where standard costs are used? What factors would you consider? Reliability of management? Reasonableness of inventory values when analytical review is applied? Construction contracts, halfway down the page, 48. Long-term contract. I say long-term, but of course if you remember from your F7 days, they're not necessarily long-term, are they? They say long-term, the instant impression is 3, 4, 5 years. But the Deloitte audit for the 2012 accounts of their client may have started in October and may finish in March, and Deloitte's have got a December year-end. That's the equivalent of a construction contract. They're doing work on the 2012 audit before the year-end, and they're doing work on it after the year-end, and it straddles a year-end. You remember the word straddle from your F6 days. It straddles a year-end, and they're earning some profits in one year and some profits in the next year. That's the same as a construction contract. It doesn't have to be a 5 or a 10-year project. It could be just a 6-month project or a 3-month project. It just straddles the year-end. But we're concentrated on, my mind is fixed on the fact that it's a long-term contract, generally a contract entered into for design, manufacture, construction or development of a single substantial asset. Major risks attaching to these contracts. Costs incurred to date may be misstated. Stage of completion could be wrongly assessed. Estimates of future costs will certainly not be accurate, but they may actually not be anywhere near. It says may be accurate, they're almost certain to be not accurate. Invoices issued, cash received to date may be incorrectly calculated. Or an account receivable may turn out to be irrecoverable. We've got an example of Mumbai Crafts and Chennai Ferries. Contract price is 120, cost to date 80, estimated to complete 50, 60% complete, progress payments received 71. What audit work would you do? Well, it jumps out of the page of you again. It jumps out at you, doesn't it? What audit work would you do?
To check the completion, whether it's 60% or...
Yeah, so you'd actually go down to the shipyard and have a look at the ferry and see, but again we have a problem, don't we? Because I hold my hands up here, I am not sufficiently skilled to go down to a shipyard, look at work in progress and say that is 60% complete. I can't do that. So I may need to have the use of an expert to confirm this estimation of the stage reached. What else would you do?
Check estimation.
Check the?
Estimated cost to complete.
Yeah, the way in which estimated cost to complete has been calculated, and to make sure that the estimated cost to complete are the future costs related to this ship and not general future costs altogether, all put together and put into this dustbin account. Make sure that they are clearly allocable to this ship. I'm surprised you've not told me that I want to get a copy of the contract. I want a copy of the contract. I want that on file. It may be that, in fact, it was in progress last year, so I probably already do have a copy of the contract, but there may have been variations. So confirm with management, by discussion with management, confirm whether the contract is still applicable or whether there have been any variations to that contract. Something else you do. Thomas? Nothing? Indra?
Maybe if the estimated cost to complete are appropriate, then we have a loss.
We do. We're forecasting a loss. And therefore we need to make sure that that forecast loss, is it 10 million? That forecast loss of 10 million is fully accounted for, in full, as soon as we recognise that a loss is forecast. So in this year's financial statements, we will be showing that 10 million loss. It may, in fact, be if we have recognised a degree of profit in the previous year, then the forecast loss of this year's income statement will actually reflect, say, 2 million profit recognised last year, 10 million loss recognised this year. We're going to have to actually recognise a 12 million loss this year. We're going to have to eliminate the 2 million from the previous year and create this loss provision of 10 million this year. Something else to do? Cost to date. Make sure the costs to date have been correctly arrived at. Make sure that, audit that 80 million. Look at invoices. Audit the progress payments. Consider whether this is the only work in progress that Mumbai Shipbuilders, Mumbai Crafts, has, because if they have others, it may be that the costs have been confused, that we've allocated to this one, the Chennai ferry job, some costs which relate to a different job. So make sure the correct allocation of expense. Review the documentation that Mumbai will have prepared in arriving at this 50 million. if we're making a loss on this job, is it possibly the case we're also making a loss on other jobs? If our estimation when fixing the contract price was so wrong, it's nearly 10% wrong, if our estimation of costs to be incurred is so wrong on this one, are we equally wrong on others? And are there going concern implications? Determine the reason why our expenses appear to be out of control. Is it something which we should have foreseen? Or is this increase in expense out of our control? And in that case, if it is out of our control, why do we not anticipate it as a contingency? How come we're not even making a profit? Normally when you fix a contract price, you fix it so that you're making a profit. Not only are we not making a profit, we're incurring a loss. If we had anticipated 20 profit out of the 120, and now we're forecasting 10 loss, we're 30 million out. We're 30 million wrong. That's 30% of our original estimate of costs. We estimated 100 million, it's now 130. That's a big variation. So you need to consider the reliability of the forecasters. And therefore also it calls into question the reliability of any estimates that the directors have made. It says audit procedures. I've got another audit procedure in my mind, and I'm surprised you've not mentioned it. This is one of those areas where knowledge of the matter is confined to management alone, or where there is an insufficiency of alternative audit evidence. And I think we ought to have a paragraph in the written representations. I think we should have a paragraph in the written representations that says they confirm that they have included all appropriate costs and that they do not foresee the loss exceeding 10 million. But also they confirm the reliability of other estimates that they've made and upon which we're trying to place reliance. Over the page 49, I'm sorry, one other thing, disclosure. Check that the disclosure of the contract work in progress is in accordance with the appropriate IAS, which I can't remember. Page 49, audit of deferred tax. Obtain a schedule from the client if the client has done the calculation. Obtain a schedule from the client of their calculations for the deferred tax provision. Confirm that the tax rate that they've used is the current tax rate. Bring forward last year's deferred tax working papers to see the provision brought forward is the same, and the provision brought forward in the working papers and now this year's working papers is as per last year's financial statements. Determine whether timing differences are reversible or not. If there is a deferred tax asset, which would be unusual, if there is a deferred tax asset, make sure that the company's forecasting profits, where they will then be able to recover this deferred tax asset, make sure that the company's forecasting profits are reasonable and likely. And check to make sure the disclosure is complete and clear. And in accordance with AIS, page 69 of the Deferred accounts, Page 69 of the Deferred accounts show that they do have a net asset. They had a net liability last year of 5 million. They've got a net asset this year of 1.7 million. So make sure that that disclosure is properly done. That's page 6970 on the Deferred accounts. So as I say, make sure that the disclosure is in accordance with the IAS. And you can put that in your answers. Make sure the disclosure is in accordance with the appropriate IAS on deferred tax. There's no need for you to worry about identifying the number of the IAS. The number of the IAS and the ISAs and the IFRSs is no longer marked. $12, isn't it? Statements of cash flow I've covered. I actually covered that earlier this morning. An audit opinion, I covered cash forecasts. Audit opinion covers the cash flow statement, or statement of cash flow. Audit where required. Make sure it's consistent, that if we're using the direct method, we consistently use it. And there's been no change. If there has been a change, it's a change in accounting policy, and last year's figures would need to be restated. Trace and reconcile all details to working papers. Obtain or prepare a supporting analysis such as tax payments and dividends. And cross-check the amount of any items like depreciation. The add-back of depreciation in the operating activities should compare with the depreciation expense as shown in the income statement note. To cross-check the amount to make sure the financial statements are consistent within themselves. Audit of leases. This is also subject to current discussion and change, because operating leases and the distinction between an operating lease and a finance lease is, because of clever people who design these leases, because of that, the distinction is becoming very fine. And yet, if you use an operating lease, the effect of using an operating leased asset could very well be the same as the effect of using a finance lease asset. It's just that it may not be for the whole of its life, or 90% of its life. It may not be for 90% of its fair value. It may be that it's only for a short period, but then it's renewable, in which case it's an operating lease because it's not for the whole of its life. But strictly speaking, and in reality, it actually is a finance lease because we do intend to renew. So there is ongoing discussion about leasing, and if you're doing P2 now, we will be going through that. But how do you audit leases? Where are you going to start? Last year's file. Bring forward a schedule of last year's leases and update it and see if any new assets add on to the schedule, any assets which have now fallen off, been recovered by the lessor, or which have been paid off, or which have been abandoned. And if it's an operating lease which have been recovered by the lessor, he's taken his operating lease asset back, update the schedule for the changes this year. Or make sure, audit the updated schedule. Review the lease agreement for each new leased asset. There's no point, is there, in getting a copy of the lease agreement for the leased assets which were there last year, because you've already got a copy. It's on last year's file. So any new leased asset, we need a copy of that lease. You need to check whether it's finance or operating. At the moment, the lease standard has not changed, so we still do have this distinction. And if it's a finance leased asset, then make sure it's appropriately accounted for. It should be capitalized and depreciated. If it's an operating leased asset, it's not. We just expense the operating lease payments. Confirm to board minutes. that each lease was authorised. Recalculate the interest. Determine it's on a consistent basis. Physically verify. Go and inspect the leased assets, the new ones. Go and inspect the new leased assets. To determine that they do exist. Recalculate depreciation. And confirm the adequacy and completeness and appropriateness of the disclosure. It's not unusual for leased assets to have their own category within the tangible non-current asset note. It would not be unusual to find leased assets as a separate column in tangible non-currents, and I'm looking again at the Deferred accounts to see if I can find details of, there we go, no we don't, property, plant and equipment, there we go. No, we've got construction in process, but we don't appear to have a separate identification of leased assets, but I know they have because I've noticed an expense of leased asset payments. Yeah, on page 50, note 9, there's an expense called hire of assets, operating leases. But they only apparently have operating leases, they don't have finance leases. Alright. Which gets us on to chapter 9, page 51, group audits.